Welcome, everyone. This is, again, as I mentioned, Virginia webinars. This webinar will focus on the significance of cash flows. So if you're ready, we'll go ahead and begin. A little background of Virginia. We are the Virginia Institute of Finance, better known as VIF. We are a US-based firm with our headquarters in Virginia, right outside of Washington, DC. We have a regional office here in Dubai, in the UAE, and we are opening an office in Riyadh, in Saudi Arabia. We hold trainings across 4 verticals. The first vertical being finance, accounting, investments, and treasury. Our second vertical consists of data analytics, business intelligence and reporting, Microsoft Office, as well as Power Query and Power BI. Our third vertical consists of internal control, risk management, and fraud detection, as well as corporate governance. And finally, our latest vertical, our specialty behavioral and technical courses, consist of subjects such as the PMP. Apologies, now you should be able to see my screen, is that correct? Can everyone see my screen here? Wonderful, wonderful. My name is Farid Sadeh. I'm a consultant with Virginia. My concentrations are in finance, accounting, investments, financial modeling, and data analytics. A complete bio on myself can be found at viftraining.com. And I'm the one who's obviously going to be holding or hosting this webinar. So just a few housekeeping issues. This webinar is being recorded. You will receive an email with the video recording, as well as any documents that we may cover over this webinar. You should receive it within a day or two at most, a working day or two. So you can also rewatch this webinar anytime at elearning.viftraining.com. We have all of our webinars posted on there. So if there's any webinar that you have missed that you're interested in watching, that you may have had an interest in attending, please visit our website and take a look. We have webinars ranging from everything from financial modeling to the CMBA certification, Power BI, and many others. If you face any technical issues, please go ahead and send me a direct comment on the chat. If you can do that, I will try to take care of your issue as quickly as I can. And you'll receive your certification for attendance with your video recording. If you're interested in learning more about what we offer, please visit our website at www.viftraining.com. You can find all of our course offerings as well as any dates, and you can go ahead and register from there. If you have any questions, reach out to us. Please don't be shy. So before we actually begin the webinar, or before we begin the topic, I should say, of the significance of cash flows, I have a question for everyone. If you can only choose one financial statement to assess the financial health of a company, which statement would you choose? The income statement, the cash flow statement, the balance sheet, or the equity statement? If you can go ahead and send me a message directly, I'll go ahead and tally up the scores and let's see what everyone is thinking. Okay, we got a couple balance sheets, all right. What else, guys? What else? Let's see. Okay, we have some cash flows. We have some balance sheets. All right, balance sheet, okay. Okay, so it looks like we are split right down the middle between the balance sheet and the cash flow statement. Well, I'm glad nobody said the income statement because that's usually the one that gets everyone. So let me just go ahead and give you the answer. The answer is the cash flow statement. Now, all four of these statements are very important. Okay, let's not beat around the bush. They are all very important. If I want to assess the financial health of a company, the health, financial health would indicate blood flow, right? Blood flow in a financial perspective would indicate cash flow. Based on that, the most important financial statement that I would use to assess the health of a company would be the cash flow statement. And you're going to find out why in this webinar. Let me just explain why the income statement and the balance sheet are not the best options for the financial health. Now, the income statement will allow you to assess the profitability of the firm, whether the company is generating profits, okay? Accounting profits, not necessarily cash flow. Now, this is important. However, as any accounting and finance major, accounting and finance professional as well can tell you, the income statement has a lot of flaws. There's a lot of non-cash items that appear there that we will have to adjust for. And there's the lack of recognition of actual cash movement, correct? Let's just take the revenue, revenue as an example. Revenue can be either customers can pay in either cash or credit. If they pay in credit, that indicates that you have not collected your cash yet. Therefore, your revenue figure is not an actual cash figure. Same thing goes with your cost of goods sold, the same methodology, and so on and so forth. But that's the major issue with the income statement. Now, the balance sheet is a very important financial statement. It's truly one of the most important financial statements. The only thing that I want to mention the only thing I want to point out as to why it doesn't allow you to assess the financial health of a company is that it does something else. It indicates the financial solvency of a company. It allows you to assess if the company, essentially, let's just break down the balance sheet really quickly, and it'll be a little bit easier to visualize. So we have three categories on our balance sheet. We have our assets, our liabilities, and our equity. What are these three items? The assets are what we own that will provide us a benefit or cash in the future. Our liabilities are what we owe or what will be a use of cash in the future. And our equity is just the residuals of that, right? It's assets minus liabilities, okay? It's just a residual ownership. So with that, what we're able to do is we're able to assess whether we owe more whether we owe more money or we have assets that can generate money for us. I'm using the terms very loosely here, but this is the essential idea. Now that, the balance sheet is very important because it allows us to know how much debt the company has, what is owed, and so on. But it doesn't tell us about the financial health of a company. It can indicate whether the company is in bad shape for sure. But as you're about to see, the key thing that all companies need to focus on is cash flow. So for those of you who chose cash flow, give yourself a round of applause. Now let's discuss the significance of cash flows. Now, before we do that, I want to give a little primer on the cash flow statement itself. Once I give the primer, we'll discuss it a little bit further. We'll discuss a few theoretical concepts. And I actually have a financial model developed that I would like to actually demonstrate why cash flows are the most, why the cash flow statement one is the most important statement, but also why cash flows are significant. So if you'll allow me, let's begin. So what is the cash flow statement? Essentially, the cash flow statement shows us the actual cash amount that has changed hands over a period of time. It follows the income statement where it covers a period of time. So typically from January through December in a normal fiscal year. And it will tell you all of the cash movements that the company had, obviously in the categories provided, such as capital expenditures, any debt repayments, and so on and so forth. So let's take a look at the cash flow statement and how it relates to the three pillars of finance. So we all know what the income statement looks like. It essentially begins with our net sales. We remove any of our costs of goods sold more specifically, and we reach our gross profit. Then we remove some operating expenses and we incorporate any operating profit. We receive or we arrive at our operating profit. Then we add any other revenues, so, other income, and we remove all the other expenses such as interest and taxes, or in this part of the world, zakah, and we arrive at net income. Okay, this is straightforward. Most people know what an income statement is, right? Now, the balance sheet is, just like we mentioned, it holds three categories: our assets, our liabilities, and our equity. Our assets being what we owe or what we own, and they're split up between current and non-current assets. Our liabilities being what we owe, split up between current and non-current liabilities. And our equity is the residual interest to the owners, right? Now, the thing I want to distinguish between the current and non-current portions are essentially the current portions are due within a year. So these will be converted into, or can be converted into cash within 12 months, whereas our non-current items will take longer than 12 months to convert. And that goes to the liability section as well. Now, mapping these three cash flow items to our income and balance sheet go as follows. Our cash flow statement essentially includes the three pillars of finance. These three pillars are the three things any company can do. The first pillar being its operating activities. So a company generates cash flow from its operations. A company can generate cash flows from investing activities, and a company can generate cash flows from financing activities. These are the three pillars of every company. They have operations, they have investments, and they have the financing aspect of that. Now, the way that these three cash flow categories link to the rest of or the other two financial statements, I should say, are as follows. Now, when we all know, or if you don't know, you're going to know now, but the way our operating cash flows from our cash flow statement begin with our income statement, right? We begin with net income and we make all of the non-cash adjustments. And then we account for the movements in our working capital, in our current assets and current liabilities, right? The period to period movements. Okay, so that's how we arrive at our operating activities, our operating cash flows, I should say. Our investing cash flows relate to our non-current assets. Our land, our buildings, our machinery and our equipment are all investments that companies make. Investments in other businesses, purchasing equity are also investing activities. So essentially the non-current portion of our assets link directly to our investing activities in our cash flow statement. So now we've crossed off our income statement, our current assets and current liabilities, as well as our non-current assets, right? Now, the final pillar of our financing activities, or our financing activities of our cash flow statement, which is our third pillar, relates to the financing aspect. How are we going to fund our operations and our investments? Now, we have two ways that we can fund a business. We can either take on debt through loans, again, in our non-current liabilities, or we can fund our business through that of equity, through capital injections, through new investors, and so on. So this is how the cash flow statement links to both our income statement and our balance sheet. And these three cash flow activities are actually, additionally, our three pillars of finance. Okay, wonderful. So let's continue. Now, what about these cash flow categories make them so significant, right? Like, what do they do basically? Our operating activities, each one of these cash flow categories has an inflow and an outflow. okay? Certain things will be inflows for them and certain things will be outflows for them. Inflows from our operating activities will be any cash collected from customers, any interest or dividends that have been received, any sale from trading securities, okay? Any outflows would be any cash paid to employees and suppliers. Salaries are a cash outflow under operating activities. Cash paid for expenses such as utilities, rent, and so on are paid under operating activities. Interest expense and taxes, purchasing trading securities like common stock are all outflow activities, right? The cash flow statement reflects the actual cash movement of the business, all right? It's not like the income statement where an outflow or a negative figure indicates that the company is performing poorly, for example, or it's detrimental to the business. Cash flows can be for investments, it can be for financing, it can be, it's really a bit more intuitive than that. You kind of have to think about it for a second. Now, our investing activities can consist of, to put it simply, inflows of selling our assets, selling our stock, selling selling any sort of investment, essentially. And then cash outflow would be acquiring investments, right? So purchasing vehicles for our business, purchasing debt, purchasing equity, making loans for other businesses, right? Purchasing bonds is actually an outflow of an investing activity, okay? And financing activities is a bit more intuitive. Financing activities is the exact same process. Our inflows are essentially issuing debt. So if we are borrowing, or a capital injection via a new investor, right? And an outflow would be the most common form, the two most common forms being repayment of our debts or dividends to shareholders, right? This is what we all want to see. We all want to see large dividends being paid to us, right? So just to think about it conceptually, this is how the cash flow statement, this is just sort of the primer on the cash flow statement. So let's just take a look at how the relationship between our three statements actually link together. So like I mentioned, the beginning of our, so if we begin with our income statement, right? Because all businesses begin with revenue, we remove our expenses and we arrive at net income. Our net income flows into our retained earnings on the equity statement. Our retained earnings, our equity statement is the equity section of our balance sheet. Net income also flows into our cash flow from operations. It is the first line item there. Then we make adjustments for non-cash items. And finally, we adjust for our working capital, and we've arrived at our cash flow from operations. Then we have our cash flow from investments, which is essentially the movement of our balance sheet items, if you recall, from the three pillars of finance. And finally, we have our cash flow from financing, which is the same methodology. It's the movement of our liabilities and the movement of our equity. So if we have any dividend payments, it will be reflected under our cash flow from financing. Now, just a little refresher on those items, our cash flow classifications. Now, let's just read and interpret a couple of cash flow scenarios before we move on. So we have, as we mentioned, we have three cash flow activities: operating activities, investing activities, and financing activities. Our activities can either be a source of cash or a use of cash, or as shown on our slide, sources of cash inflows or sources of cash outflows. Okay, traditionally, any sale of goods and services is a cash inflow under our operations. Any purchasing of supplies, payment of our operating expenses is a cash outflow from our operating activities. Essentially, the operating activities is the cash movement of our income statement, right? More so our operations, our actual operations. Our investing activities consist of any any cash inflows include any sale of our fixed assets, sale of our financial assets, selling our equity that we hold in other businesses, collecting cash on loans that we've made. Now, vice versa, the opposite of that is one of the most commonly used terms in finance: capital expenditures. CapEx is it's an investing activity, and it's a cash outflow. Long-term investments are a cash outflow. Now think about it. The cash moving hands is exactly how you want to think about the cash flow statement. Our financing activities, we have for cash, so for sources of cash, are issuing any stock, issuing any debt, whether short-term or long-term. And any cash outflow would be any repayment of stock, any repayment of debt, right? Repayment of stock being an investor wanting to cash out his share. A dividend payment would be a financing activity as well. Ideally, the way we would want a cash flow statement to look is we want our cash flow from operations to be as positive as possible. As positive in a realistic sense as possible, without any accounting fraud, of course. Our cash flow from investing activities, we would want it to be negative because we need to, I should say, make capital expenditure investments. We need to maintain our buildings. We need to maintain our software. We need to maintain our offices, our office space, our equipment, our machinery. So we expect there to be some sort of investment, whether it's significant capital expenditure or even maintenance CapEx under our investing activities. And finally, under our financing activities, we want our financing activities to overall be negative. Negative because we want to keep our shareholders happy. And how do we do that? We keep our shareholders happy by paying them a dividend. So ideally, we would want to see a mix like this. However, the summation of these is actually, in this example, I should say, is negative. And we would prefer not to see that. But we would hope that our operating activities is large enough that it can fund both our investing activities and our financing activities. Now, from time to time, our investing activities and financing activities will be positive. However, it's a bad sign if that positive is consistent. Why? Because that would indicate we're selling a lot of our fixed assets consistently. It could indicate. And also it could indicate that we are actually relying on long-term or short-term debt to fund our operations. We do not want our operations to be negative for the long run. That is not good. Okay, that is not good at all. We want this guy to be positive and these guys to be negative. However, from time to time that will change. But if that mix does change, we would like it to be for the short term and not the long term. So what I just described was the cash rich standard. We want our operating activities to be positive, our investing activities to be negative, and our financing activities to be negative. Ideally, we want our operating to be able to fund our investing and our financing activities. Now, depending on where you are in your business cycle, you might have your financing activities fund your operations, and vice versa. Startups, for instance, typically have financing activities that fund their operations until they reach a period of growth where their operations can actually turn around and fund their investing and financing activities. Now, that takes a great deal of patience because it's not easy to see your business continuously make losses, right? So let's just understand. Let's just look at a few steps of how you can understand your company's cash flow. So the first thing you want to do is you want to determine if the company is consistent with the cash flow rules, being your cash flow from operations is positive, your investing activities is negative, and your financing activities is also negative. Then you want to understand the actual cash movement within those other activities, within your investing and your financing activities. You want to assess where the cash is going, whether it's going in CapEx or investments in businesses or and so on. You also want to assess your financing activities. Where is your cash flow going there? Is it going to pay down debt or is it going to pay dividends, right? There is a certain level of debt every company can benefit from. However, anything beyond that becomes detrimental to the value of the business. So ideally, management should be aiming to keep their debt balance right around that range where it optimizes their capital structure. Now, that's a discussion for a different topic, which we will save for next year. But that's just something to keep in mind. Now, finally, you need to determine where your cash came from. Did it come from this year or this year's cash movements? So essentially, the net movements in our cash flow statement. Or did it come from last year? Ideally, we would like it to come from this year. We don't want to live off of our savings, right? If you think about it from a personal finance level or personal finance concept, you don't want to live off of your savings. You would prefer, or you should ideally have your income be able to cover all of your cash outflows for the month, aka your bills, and you want to have something left over at the end of the month that you can save for the future, right? So that's just something to keep in mind when thinking about your cash flows statement. Now, this brings me back to my initial question. Why are cash flows significant? Why do we worry about cash flows, right? We already said they are the most important the cash flow statement is the most important financial statement, but why? Let's just look around right now and think about our current environment. We are facing a pandemic. The whole world is facing a pandemic. And over the last 8 months or so, thousands of businesses worldwide, if not millions, I truly don't know, but I can say with confidence, thousands of businesses have shut down. Now, why did those businesses shut down? Did they shut down because their products are no longer in need? Did they shut down because they committed fraud? What was the reason? Well, I don't think, maybe some of them, maybe some of their products were no longer in need. Maybe some of them committed fraud, but for the most part, these businesses did not have the appropriate cash flow. Okay. They didn't have the cash flow that they needed to pay their expenses, to pay their rent on their office, on their restaurant, on their kitchen, whatever. They didn't have the cash flow to pay their employees' salaries. They were just completely stuck and didn't have any cash reserves in order to continue running the business, right? Now, why are cash flows important in another sense, right? So we understand for operations, it is very important that our cash flows are able to pay our expenses, right? In order just to run the business. This comes as common sense. The second thing, why are cash flows significant? Well, we need cash flow to pay down debt. You can only refinance debt so much that the lender will eventually stop you and ask you to start paying him back. So cash flows are extremely important when it comes to paying down debt. They are very important when it comes to, and again, this is a topic for another day, but when it comes to a leveraged buyout. Leveraged buyouts depend heavily on two factors, the borrowing of debt and the ability to pay down that debt via the company's free cash flow. Okay. Now, the third reason, or the third category for why cash flows are so significant involves making investments. Companies need to, as we just discussed a few minutes ago, make capital investments. They need to make capital expenditures in order to build a new warehouse, to purchase that equipment or machinery that's going to allow the company to produce, 5x the amount of units they produced last year, whatever. It's extremely important that companies have the cash flow to do that. Now, the alternative, if the company doesn't have the cash flow to do that, is, of course, they could borrow. But this brings us right back to our initial concern. Companies can only borrow so much. They need to generate the cash flow in order to pay down that debt. They need to generate that cash flow in order to make the appropriate investments, the appropriate acquisitions, whatever it may be. Okay. And finally, Finally, if you recall from your introduction to corporate finance course, there's a couple of ways to value a business, right? We have one, the comparables approach, where the value of a business is going to be based on the value of a similar business, similar or identical business, right? We have the net asset approach, where the value of the business is it's the value of the assets the company owns, right? So it's the value of the cash on the balance sheets, the machinery, the equipment, the vehicles, less any debt or any liabilities the company may have, right? So so this is the second method. The third method is actually something called the income approach. The most famous of the income approach is the DCF, the discounted cash flow analysis. And this is where I'm going to take us now. So in order to value a business, right, one school of thought is the value of a business is worth the value of the future cash flows the company is going to generate discounted to today. Okay, now what does that mean? That means that my business is going to, let's say, produce 1,000, or no, let's pretend I'm making more than $1,000 a year, but let's say my business is going to produce $100,000 every single year, for the next, for infinity, okay, till forever. The way I'm going to value this hypothetical business is I'm going to discount all of these cash flows from infinity to today at a certain discount rate, and I'm going to say that this is the value of my business, okay? Now, you're probably wondering, what cash flows, Fareed? Are you talking about the ending cash, the change in cash? What are you talking about? We'll get to that momentarily, but I want you to keep this thought in your mind. Now, something I want to kind of deviate from, because I need you to keep in mind before we go through our example, is something within our cash flow from operations. Now, if you recall, we had a section called changes in working capital. Now, there is a category of financial analysis called the management and activity ratios. These consist of our days sales outstanding, days inventory on hand, and days payables outstanding, okay? These three basically consist of days sales outstanding are the number of days it's taking us, or the company, to collect the customer's payment. So basically, how long it takes to convert sales into cash, okay? The longer the number of days it takes, the worse it is for our business, okay? That means we are not collecting cash. We have more outstanding, more outstanding cash due, so we're not generating that cash flow, okay? If we're generating cash flow immediately, this would indicate that we have an all cash business. Basically, we don't have any payables or any receivables, I should say, outstanding, meaning we are not waiting for anyone to pay us. They have paid us and we are happy campers. The second category of our activity ratios is the days inventory on hand. This indicates how long it takes for the company to sell its inventory. Basically, from the time the company purchases inventory to the time it converts that inventory into sales, how long does it take? Now, this follows the same logic as the days sales outstanding. The longer the number of days, the worse it is for us, because it basically indicates that it's taking us this many days for us to convert our inventory into cash. If we have purchased, heavy machinery, very expensive machinery and equipment, it's going to end up sitting in a warehouse for however many days it's taking us. And that is, those products could become they could become obsolete if technology is changing quickly. They could have a useful life, a perishable life, where they could go bad if not used within a certain amount of days, and so on. So ideally, we want the shortest number of days available for our days inventory on hand. And finally, our days payable. Now, our days payable is how long it takes us as a company to pay our bills. Now, the logic with our days payable is the exact opposite of our days sales outstanding, okay? What our payables is saying is the longer it's taking us to pay our bills, the longer it's taking for our cash to leave our hands, okay? So if you think about it conceptually, if I have an average payables of 365 days, that would mean that I am typically holding my cash for 1 full year before I pay my suppliers. Now you might say, wow, that's great, Farid, you just gave me the shortcut and this is what I'll do in my business and I'll maximize shareholder value. I'll make my company, cash flow positive and everything will be wonderful. Well, let me just stop you right there. That's not the best practice, and I'll tell you why. You have to think about it from your creditors, because now you're the one that has been provided credit to, point of view. If you take longer than a certain number of days, they're not going to deal with you in the future, right? If you're purchasing expensive machinery, expensive equipment, expensive inventory, your customers or your suppliers or whoever are not going to want to deal with you if you're only paying them once a year. So this is something to keep in mind. Now, for payables, the shorter you're paying, the faster cash is leaving your hand, which means that you have less cash flow, or you have more negative cash flow on your books, right? You're actually realizing more negative cash flow the quicker you're paying. So this is sort of a balancing technique that can essentially help you to optimize your cash flow. Now, ideally, what you want is you want your days sales outstanding, your inventory, and your payables to pay each other off. So basically, you want to be collecting quickly enough from your DSO. And by the way, I should have mentioned this earlier, but your DSO, your daily sales outstanding, relates to your accounts receivable. Your days inventory on hand is about your inventory, obviously. And your number of days payable is related to your accounts payables. Okay. Now, ideally, in order to manage your working capital, what you want is you want to have your customers pay you as quickly as possible, within reason. You want your inventory to convert into cash as quickly as possible. And you want your payables to be essentially in a reasonable, you want to pay your bills in a reasonable amount of time. Ideally, you want your working capital to fund itself. You don't want to have to invest capital or direct any of your cash flow to fund your working capital. Okay, because within your working capital, you might have things like accrued revenues. You might have things like rent, utilities. Maybe some things you haven't paid, and these are things that you need to pay pretty frequently. Now, in order to assess your working capital, there's something called the cash conversion cycle. This basically calculates the number of days it takes you to convert all of your working capital, all of these items, into cash. The formula is very simple. It is simply the number of days sales outstanding plus your inventory days minus your accounts payable days. Okay, so the average. There is no rule of thumb. There isn't any real. Well, maybe there are some rules of thumb, but there isn't a real concrete answer as to what's too long and what's too short. It is business by business dependent and industry by industry dependent. However, if you think about it conceptually, typically you want your customers to pay within 30 days. You typically want to turn your inventory over within 30 days. And typically you pay your bills in 30 days. So overall, your cash conversion cycle should be about 30 days odd. But again, that's a very high level rule of thumb, but not even a rule of thumb, but it's just a high level conceptual framework that I'm kind of painting, but it is business and industry dependent. Now, why am I worried about this working capital? Besides this whole thing about funding itself, right? Well, we don't want to inject cash there. Well, because if you recall, I said the last thing that I mentioned about why cash flows are significant relates to valuing the business. Now, you remember I asked you, or you asked me, I should say, about the cash flows. You said, Farid, what kind of and I know I'm putting words in your mouth, but you asked me, Fareed, what kind of cash flows are you talking about? Operating cash flows, investing? What do you mean? Well, the cash flows I'm talking about are actually free cash flows. Now, what are free cash flows? Free cash flows are the cash flows available to all investors, to all who have claims on them, whether you're a debt holder or you're an equity holder, okay? After you pay your operations and after you make your capital investments. So it's essentially your cash flow from operations minus or plus your cash flow from investments, right? You just want to reduce it by your capex, essentially. This is a high level, okay? This is a high level example. So just for you to understand why cash flows are important, okay? Now, there's a secondary form of cash flows that we're not going to dive too deep in, but it's essentially called free cash flow to equity. The difference between the two is essentially the principal debt payments. All this means is you're paying your debt holders now. You're taking your free cash flow to the firm, your FCFF, and now you're paying your debt holders, okay? After those debt holders have been paid off, all the cash flow left over is for the equity holder. So it makes, it's essentially for, it's the cash flow available for them. So why am I focusing on this thing? Why am I talking about free cash flow to the firm, free cash flow to equity? Well, for a very important reason. I want to demonstrate why cash flows are important with an example, okay? Like I said, I have created a financial model for us in order for us to basically see how our working capital, well, for one, see how our working capital can affect our cash flow. Two, I want us to determine whether our cash flows make sense. And three, I want to apply these cash flows in order for us to value a hypothetical business, okay? So let's begin with that. Okay, so on my screen, you can see a simple example of the sheet I'm on is called the working capital schedule and DCF valuation. If you recall, I mentioned that you can value a business using a DCF. Now, a DCF is essentially, if you recall, the present, it's the discounted cash flow analysis. All that we're doing in our DCF is taking our cash flows and discounting them back to today. We will get there in a moment. I want to focus right now on our working capital, okay? As you can see here, we have our free cash flow calculation, which it begins with net income. We add back our depreciation, our deferred income taxes, and then we have our changes in our working capital, our accounts receivable, our inventory, our accounts payable, our other current liabilities and current assets. And then we have our investments, our CapEx and intangibles. And we sum them up to reach our free cash flow to the firm. Now, you're probably noticing this looks very, very similar, at least this section, to our cash flow statement, correct? Well, that's not by any coincidence at all. Our free cash flows are a version or a variation of our cash flow statement. If you recall, we said our free cash flows to the firm, I should say, are essentially our cash flow from operations plus our cash flow from our investments. So let's take a look. We have our free cash flow from our operations here, right? This is correct. And then we have our our cash flow, our investing activity cash flow items. And that gives us our free cash flow to the firm. Excellent. Now, it looks like we have a missing piece here. So let's see what we have. All right. So this looks like our working capital items. Now we have our days outstanding here, and we have our other current assets and liabilities as a percentage of our total costs, right? So we have our days per year, we have our revenue, we have our total costs. Wonderful. And here are our historical working capital balance sheet items. And at the bottom, we have our changes in working capital, okay? These changes are what are calculated here in our free cash flows. Now remember, our free cash flow to the firm, our free cash flow calculations capture the actual cash movements. So it's the period to period movements of our balance sheet items. So let's begin by filling out our working capital projections, okay? We want to forecast our working capital items from accounts receivable all the way down to our other current liabilities. Now, we are going to do this using our days sales outstanding, our days inventory outstanding, and days payables outstanding, as well as applying a percentage for our other current assets and our other current liabilities. The model will automatically calculate, but let's think about it conceptually. This is a form of forecasting, okay? Now, I see here, let's begin with our working capital items. So historically, it looks like we had our accounts receivable, between 31 days, 21 days, and 27 days, okay? So to keep things simple, let's just take an average of these 3 periods. Now, what I'm going to do is I'm just going to anchor this, okay? Because what I want is I want to keep that average for these 3 periods for 2017, 18, and 19 figures to project for the rest of the forecast period. Now, if I had more information, I could make a better assessment of what my accounts receivables balances would be. But for now, let's just keep it simple. Let's just take the 3-year average. Wonderful. Now, we can see here that our accounts receivable balances are going to be growing. They are growing because what's happening is we are basing our accounts receivable based on our revenue and based on this number of days that we're going to be collecting. So as our revenue grows, if our days remain constant, our balance should grow mathematically, right? Looking at the formula, what we have is we have our revenue divided by the number of days per year times the number of days it's taking us to be collected. So over 366 days, we're collecting cash on $11 million odd of revenue every 26.4 days. Okay, that's all intuitively, that's all it's saying. All right. Now, before we move on, I just want to assess something. You can now see our cash flow items below. We now have a movement, right? So we see our cash flow, our free cash flow, I should say, has gone from 113 odd thousand to 274,000. So because of this, we're able to collect cash. Okay, or sorry, I shouldn't say that. But let's just see what will happen if my days actually increased. So pay attention to this number here. All right, this 113. What's going to happen if it's taking me longer to collect cash from my customers? Let's say it becomes 45 days. Do you think our cash flow, our free cash flow, is going to be higher or lower? Can we have some guesses? Can you guys send messages? Let's see. Is our cash flow going to become higher or lower for this period? What do you guys think? Any guesses? Anyone? Lower? I'm seeing lower. I'm seeing lower. Higher, higher. Okay, let's see. Let's see. All bets are done. We're closed. Let's see. So we have a few higher and a few lower. Okay, it looks like we're split. Wow, look at that. Cash flow has now become negative. Why did it become negative? It became negative because what we did was we increased the number of days it's taking for us to collect cash. If it's taking us longer to collect our cash, what's happening is we are not collecting that cash, basically, right? If it's taking us longer to collect that cash, that's cash that's not in our pockets. So basically what happened is, conceptually, the longer our days are, the more cash we have outstanding. The more cash we have outstanding, the less cash we have in our pockets, which means we are generating less cash flow. So that's a good. That's good. Most people believed it was lower, which is excellent. Let's try now with inventory. Let's do the same thing with inventory. okay? I have copied the same formula. I'm just taking the 3-year historical, okay? Now, do you think, let's have another round now. Let's see if people can redeem themselves. If we change our inventory from 45 days to 60 days, is our cash balance going to increase or decrease? Let's go. Let's see. What do you guys think? Increase. I see increase. Cash is going to increase. Okay. Who else? Okay. I'm seeing a few people. Okay. Okay. Decrease. Okay. All right. Let's see what's going to happen. Now, our inventory days, remember our days, the days it's taking our inventory to be converted from purchasing that inventory to selling it. It's taking us longer now, which means we have more cash sitting in a warehouse, which means we are not collecting cash, which means our cash flow declines. Okay? Good guess, guys. Good guess. Now, we have one more. Now, we have our accounts payable. Our accounts payable, again, remember, we're keeping this very high level, very, it's an average, okay? Right now, we're at 56 odd days. This is our cash flow. If we convert our accounts payable to 30 days, okay? Sorry, my Excel is freezing. If we can convert this number, this days balance to 30 days, are we going to have more or less cash? What do you guys think? Okay, is cash going to go up or down? If our accounts payable declines, okay, less cash since it's an outflow, down, less. Let's see. Cash was decimated. It was decimated because it went from what? Nearly $200,000 down to $6,000 because what we did was we paid faster. We paid our bills way too quickly. Man, this would not be good, right? Remember, the longer we take to pay our bills, the more cash we're able to hold on to, all right? And if we're able to hold on to more cash, we can do other things with it, like pay our employee salaries, pay our rents, pay our debts back, okay? So very good work, guys. I'm just gonna copy this formula for the remaining items, and let's see what happens, okay? So these are our cash flows for the projections, for the 5-year projections, okay? Now, this is how we can essentially manage a business, right? Ideally, we want this cash flow not to be negative every year, but we would want it to ideally, we would want to be making money off of our cash flow. How would we be making money? If basically we become a cash business, right? If we have no accounts receivables outstanding, that would indicate that our customers are paying us in cash. If our customers are paying us in cash, you can see how high our cash flows jumped, right? But it turns out that management, air quotes, management doesn't have plans for our business to convert into a cash business. So we'll just have to use this simple assumption for now. Now, let's continue. If you recall, I said we can also use cash flows to value our business, okay? So remember, so let me just paint this picture for you conceptually. The value of a business today is based on the cash flows it can generate in the future, discounted at a rate to arrive to the value today, okay? With that, now I said cash flows projected in the future, right? I have 5 years of cash flows. I remember I said my business is going to live into perpetuity. It's going to be forever. Well, I have a way to basically alleviate for that. Obviously, I'm not going to project my cash flows forever because after a certain amount of time, I lose clarity in the future, in my forecast, right? I don't have confidence in my forecast 50 years from now as I do 1 year from now. So to mediate or to remedy that issue, I have something called the terminal value. So we're not going to spend too much time here explaining the ins and outs, but what I want you to pay attention to is this number here. the equity value, okay? This, based on these cash flows, all right, this is the value of the business today. What I did was I took these cash flows, okay, including the terminal value. So for those of you who are not familiar, this terminal value basically will it basically takes into consideration all of the cash flows after my final forecast period forever, okay? Now, what I did was I discounted these cash flows based on this 12% discount rate. It's an arbitrary rate. Let's just move on with it, okay? This is the present value of my cash flows, and this is the total of those cash flows, all right? Now, the present value of this terminal value, I'm discounting at 12%, and I'm arriving at roughly 5 million for the enterprise value. Now, I have my net debt, which is simply my debt minus cash. In this case, I have more cash than I did debt, so the figure is negative, and I reduce my enterprise value by my net debt to arrive at equity value. Now, because my net debt is negative, indicating I have more cash than I did debt, my equity value is actually higher than my enterprise value, okay? So let's just assess something, okay? You see our cash flows here. Let's test something. What is gonna happen to the value of my firm if I become an all cash business, okay? If I make all of my accounts receivable 0, is the value of my business going to go up or down? What do you guys think? Okay, I see up, I see up, I see down. What do you guys think? Up, okay. All right, let's see what's gonna happen. Can somebody mark this number down? 7.6 million, okay? Roughly 7.6 million. What's gonna happen if all of my receivable days become 0? Basically, I've become a cash business. If I become a cash business, I will increase the value of my business or my firm by nearly $3 million. That is wonderful, okay? That is truly wonderful. Now let's go back to what the figures were. Let's leave them as is, all right? There's something called the discount factor. If I increase the discount rate, my rate will be higher and my cash flows will be lower, okay? The present value of my cash flows. So you can see my discount rate increasing here. It's lowering the value of my firm, okay? So the second component when it comes to valuation, which again is for another video, is the discount factor. But I do want you to be aware of what the discount rate can do to the value of your business, all right? So this is why cash flows are significant. This is why investors focus on cash flow. This is why you should be focusing on your cash flows, on business's cash flow statement, more so than the balance sheet and the income statement. Now, I will say that with a caveat. The income statement and balance sheet are extremely important. Do not misunderstand what I'm saying. The only thing I'm saying is the cash flow statement is what you can use and what you must use in order to assess the financial health of a company, in order to assess whether the company can pay its bills, whether the company can grow organically, and what the value of the company is, okay? This is called intrinsic valuation, and based on these assumptions that me and my team have put together, the value of our business is $7 million, okay? Based on all of these assumptions that we came up with, okay? If we're able to improve our cash flow, we are able to improve the value of our business. If we're able to improve our cash flow, we're able to improve the financial flexibility of our organization. Cash is king, and I hope that you guys enjoyed this webinar. If you have any questions, if there's anything that wasn't clear, if you're interested in chatting, feel free to reach out to us at www.viftraining.com. You can see our courses that we are offering. You can see our previous webinars. If you have any questions, please do not hesitate to reach out to us. If you have questions, interests, anything at all, please reach out to us at info@viftraining.com. I thank you for your time. I thank you for your questions and your participation. And that's all I have for you today. If you have any questions, I'm here. Otherwise, this has been Fareed Sadeh and with Virginia Webinars, and I hope to see you guys next time. Thank you.